Bitcoin is not simply crashing, it is testing demand. That is the key difference in this market. A crash is the word people use when fear becomes the whole story. A demand test asks a better question. Who is still willing to buy when the chart is under pressure? Bitcoin has broken down from its recent recovery structure. This is no longer a clean sideways pause or a calm waiting range. Bitcoin tried to recover, failed to hold strength, and moved lower. Again. That makes this moment more serious than a normal pullback, but it does not mean we need to panic. The better way to read this market is through liquidity, ETF flows, spot demand, stablecoins, and market structure. When Bitcoin falls sharply, most people only look at the red candle. They ask whether the bull market is over or whether a deeper crash is beginning. Those questions are understandable, but they are not the most useful questions. The better question is whether there is enough real demand to absorb the selling after the breakdown. Bitcoin has now moved into a zone where the market has to prove itself again. Buyers cannot simply say they are interested. They have to show up in the data. ETF flows need to stabilize, spot demand needs to return, stablecoin liquidity needs to become active, and price needs to stop failing every time it tries to recover. In a strong market, dips are absorbed quickly. Sellers push price down, but buyers step in with confidence. Demand appears, volume improves, and price starts to reclaim important levels. That is what a healthy pullback often looks like. In a weaker market, the same dip behaves differently. Price falls, tries to bounce, and then gets sold again. Each recovery attempt becomes smaller. Each support zone becomes less convincing. Instead of buyers controlling the pullback, sellers keep testing how deep the market can go before real demand appears. That is why the phrase demand testing is more useful than simply saying crash. It keeps the analysis focused on evidence, not emotion. The first thing to watch is market structure. Bitcoin had a recovery attempt, but that recovery did not hold. Markets often reveal strength or weakness not only by how they fall, but by how they bounce. A strong bounce shows urgency from buyers. A weak bounce shows hesitation. And when a weak bounce fails, the market starts asking a harder question. Was the previous demand real, or was it only short-term positioning? Bitcoin is now testing whether buyers are still willing to defend lower levels. It is testing whether institutions still want exposure after recent pressure. And it is testing whether liquidity is ready to move back into risk, or whether that liquidity is still sitting on the sidelines. The second thing to watch is ETF demand. Since spot Bitcoin ETFs became a major part of the market, Bitcoin has become more connected to institutional flows and broader risk appetite. When ETF inflows are strong, Bitcoin has a steady source of demand. When ETF flows weaken or turn negative, the market loses one of its important support engines. That does not mean ETF outflows automatically destroy Bitcoin, but it does mean the market becomes more sensitive. A dip that might have been absorbed quickly during strong inflow periods can become more dangerous when ETF buyers step back. The issue is not only that price fell. The issue is that price fell while the market is questioning whether the same demand that supported Bitcoin earlier is still active now. The third thing to watch is spot demand. This is different from leverage. A market can look active because traders are taking positions, but that does not always mean real buying demand is strong. Sometimes traders are simply betting on a fast rebound before real buyers have returned. That can make the market fragile. If too many traders expect a quick recovery, but spot demand does not appear, Bitcoin can move lower by forcing those positions to unwind. A healthy recovery needs more than hope. It needs absorption. It needs buyers willing to take the other side of selling pressure. It needs price to reclaim lost levels and hold them. And it needs follow-through, not just one green candle. The fourth thing to watch is stablecoin liquidity. Stablecoins are important because they represent potential buying power inside the crypto system. But potential liquidity is not the same as active demand. A large stablecoin supply does not automatically mean Bitcoin must rise immediately. Stablecoins can support risk assets when confidence returns, but they can also remain parked on the sidelines when traders are uncertain. So the real question is not whether stablecoins exist. The real question is whether stablecoin liquidity is moving into Bitcoin, Ethereum, and broader crypto risk. In a strong crypto market, sidelined liquidity becomes active. In a fearful market, it stays defensive. Until that liquidity moves, Bitcoin remains in test mode. This is the main idea of the video. Bitcoin is not simply crashing. It is testing whether the previous demand story is still alive. If this is only a liquidity flush, the market should begin to show signs of repair. Selling pressure should slow. Bounces should become stronger. ETF outflows should stabilize. Spot demand should improve. Bitcoin should begin reclaiming important levels instead of rejecting from them. But if demand remains weak, the market may need to search lower before finding real buyers. That does not mean Bitcoin is finished. It means the market is repricing risk and forcing participants to prove conviction at lower levels. There are three confirmation signals that matter now. First, Bitcoin needs to stop failing every bounce. One green candle is not enough. Buyers need to defend a level, push price higher, and prevent sellers from immediately taking control again. Second, ETF flows need to improve. If institutional demand continues to weaken, the market may stay fragile. But if outflows slow or inflows return, that would suggest larger buyers are beginning to see value again. Third, stablecoin liquidity needs to become active. The presence of stablecoins is not enough. The market needs to see sidelined liquidity willing to rotate back into risk. Until those signals appear, this is not a clean recovery. It is a demand test after breakdown. The goal is not to predict every short-term move. The goal is to know what evidence matters. For the calm metrics, the framework is simple. Price shows the stress. Liquidity shows the fuel. ETF flows show institutional demand. Stablecoins show potential buying power. Market structure shows whether buyers are actually winning. Right now, price has already shown the stress. The next question is whether the other parts of the system can respond. So instead of asking, is Bitcoin crashing? The better question is this: is Bitcoin finding real demand, or is the market still searching for the level where buyers finally step in? That is the real liquidity test. This is not the moment for hype. It is not the moment for fear. It is the moment to watch the evidence. Because in markets, the most important signal is not always the first drop. Sometimes the real signal comes after the drop, when we see who is still willing to buy.